Okay, folks, so right now we are in this market environment where we've had most of the year being a complete dirty bloodbath. But since lows declared around June's Fed meeting, we have had a sizable recovery. Then another sell-off, but now markets are trying to rally, do a little rallyto into tomorrow's CPI report. And right now there's that big controversial question that is being debated, which is, have we bottomed? Every single extra green day that the market adds makes market participants ask, have central bank and inflationary worries been overblown? Have global economic catastrophe worries been overblown? Are these green days going to continue this month, or should we just wake up when September ends? At the end of the day, we could talk about whatever data points we want, and we can project what the Fed's going to do all we want, but people are substantially less anxious right now and much less willing to push sell at every single news drop these days, right? Which is making a lot of people ask, hey, is this here the bottom, and are we just now on a rocky but overall pathway to new all-time highs again? And you already know my take on this and the collision course that the stock market is on with the US economy, the central bank, and really the overall global economy. But in today's very quick video, I actually want to go through what money managers and stock market participants said is going on in the latest Deutsche Bank survey that just came out. I'm under the impression that the survey was actually supposed to be released on the 22nd, which is still another 10 days from now, but it was actually leaked early, and what it reveals is really quite telling. Let us get right into it, and this video is brought to you by the up to 13 free stocks that you will get with Moomoo if you sign up and deposit using our link down below. Okay, so the first question is, when will the S&P 500 hit its lows for the current cycle? 9% said it's already hit its lows for the cycle in June 2022. 33% said before year-end 2022. And 58% said 2023 or beyond. So in other words, a combined 91% of survey participants do not think this June trough was the bottom. And more than half think the market won't even bottom in 2022 at all. I ran a Twitter survey this morning, and out of a 500 vote sample size of our viewers, 30.2% think the market already bottomed in June 2022, 39% think it'll bottom before December 31st, and 30.5% think it'll bottom in 2023 or beyond. That's actually a pretty damn big divergence from the Deutsche Bank survey. The majority of our viewers surveyed think that the market has or will bottom this year, whereas a majority of survey participants think it'll be bottoming in 2023 or beyond. Very, very interesting. If you're in the camp where you think it's going to bottom this year or has bottomed already, let us know why you think so down below. My thesis on this is that retail traders are not as inclined to believe the Fed when the Fed is saying that they're going to do what they need to do to get inflation down. I think that a lot of retail traders are under the impression that the Fed is going to back off at a very, very, very early point. And all of a sudden the rate hikes that the market is trying to price in aren't going to actually come. And thus boom, boom, pow, pow, all-time highs, and inflation is still way above target. But the market participants and money managers in the Deutsche Bank survey are actually starting to believe the Fed, which is very, very interesting because they didn't previously. Now moving on, when asked, is the S&P 500 more likely to hit 3,300 or 4,500 first, you now have 74% of participants who think it'll hit 3,300 first. For context, the S&P 500 as of right now is at 4,100. If it hit 3,300, that would be another near 20% drop from current levels. If it hits 4,500, that would just be a 9.5% increase from current levels and would still be about 6.5% down from all-time highs that we declared at the very, very beginning of this year. So net and in effect, nearly 3/4 of participants believe that the overall market has another 20% to fall before it can come anywhere near all-time highs. Next, will the 10-year Treasury yield hit 1% or 5% first? 73% of survey participants believe it will hit 5% before it hits 1%. Right now, it's at 3.358%, which is more than it's been for 5 years, right? Markets which had been at much lower levels in 2018 and 2019 tanked as those yields went up, right? And so as we break past those highs, market participants are basically saying, hey, you haven't seen anything yet. This isn't going to stop here. It's actually going to go up to 5% at least before it goes back down to 1% again. aka participants are expecting that the Fed is going to have a much more aggressive hiking trajectory than is currently being priced in, which corresponds to why they believe the S&P 500 hasn't bottomed yet. Next, they went and asked participants, when will the next US recession begin? They are presumably talking about the never declaration of a recession, which has a much higher standard, a much more dire standard for actually declaring a recession, not just the 2 consecutive downtrending quarters. And as of the last meeting, 79% said 2023. Only 10% said 2022, and you contrast this to, say, the February survey from earlier this year. Back then, only 2% said 2022. 29% said 2023, and 45% said 2024. Now only 6% of participants think the next recession is coming in 2024. And as the year ends, less people expect it to come in 2022. But would you look for a moment right here? Now, 79% of people think it's coming in 2023. That the big recession that everybody's worried about is actually coming in 2023. 79% of people on the survey. In other words, the market went from expecting a recession at some indefinite point in the future in 2023 or 2024 or beyond that, and now they've narrowed it down to expecting it to happen in 2023. It's no longer some indefinite thing that's happening at some point in the future. It's now 2023, the most likely scenario. And this is the majority of participants. But I think this last question here is one of the most telling if you read between the lines. The survey asked, in which direction are the following central banks likely to make a policy error? The choices are don't know, hawkish, they will get it about right, or dovish. And you have 3 central banks. You have the Fed, you have the European Central Bank, and then you have the Bank of England. Now, when it comes to the Fed, you now have more participants expecting them to get it right than at any point in the last 5 surveys, with now 37% of participants expecting them to get it right. Now, this jumped from 17 to 37%. That's a massive jump in confidence in the Federal Reserve. And if you look very closely, that almost all came from the group of people who were previously expecting the Fed to be too hawkish. So all of these people that thought the Fed was too hawkish in April watched the Fed become even more hawkish, and now they've decided, likely because of the CPI trajectory, that they agree with the Fed's heightening hawkishness. And funny enough, you even have a slight uptick in participants thinking that the Fed's slated hawkish trajectory is actually too dovish. So in totality, my takeaway from the Deutsche Bank survey is that market participants are increasingly expecting the Fed to be more hawkish. They are increasingly agreeing with the Fed's decision to become more hawkish, and they increasingly think that the market and the economy is going to see another massive round of pain in 2023 because of this. Now, this is extremely contradictory to what the market is trading on right now and what it's been trading on during this overall recovery. It's been trading on what? It's been trading on this idea, at least for the moment, that, hey, inflation is indeed to some extent transitory and about to start plummeting, and that the central bank is not going to have to be as aggressive as they are saying, that they're kind of doing a shock and awe policy of trying to shock the markets into tightening on their own, and not actually going to follow through with it at the end of the day. But if you look at the Deutsche Bank survey, it shows that while market participants may indeed be trying to scalp some moves on the overall rebound rally, it also does not seem that they really believe that it's going to continue. In the past, we have seen, especially during the dot-com bust, a period of time where you could have 3 to 6 months of an aggressive uptrend and then just go right back to a cycle down. So these surveys, at least in my view, indicate that a lot of market participants think that we are still in that overall downtrend despite the little recovery that we have had. That being said, at the end of the day, it doesn't really matter where the market goes. What matters is how you are attacking it. As traders, the goal is to have a plan for every market environment, trade with the trend, exploit opportunities when you see them, and not try to lean too much on a crystal ball. But at the same time, it is also very, very important to be able to be aware of how the market is trading, how the market is thinking, and the overall trend that we are currently seeing in this market. But anyways, to conclude this video, I want to ask you 5 questions, and if you have a few minutes to respond, I'd appreciate a comment down below. Number 1, do you think that inflation is over? Number 2, has the market bottomed? Is the central bank going to be too hawkish, going to do the job just right, or is going to be too dovish? When is the next US recession going to come? When do you think that the Fed is going to reverse policy? I'm very interested to hear what you think down below, and I will read the comments later on this evening. Anyways, folks, that caps off the video. Make sure to get your up to 13 free stocks with Moo. Make sure to hit that ravishing like button and subscribe, and I will see you in the next video.